Listen, let me tell you what separates random losers from consistent winners in trading. Winners do not trade based on emotion. They trade with a written plan. Today, you're going to build your first simple trade plan, one that defines your entry, your stop loss, your target, and your risk, so you stop guessing and start executing with clarity. If you're ready to trade with structure, hit like and stay with me. Chapter 1. What is a trade plan and why you need one? A trade plan is simply a written set of rules that answers 4 questions. Where do I enter? Where do I place my stop loss? Where is my target? How much am I risking? Beginners trade without these, and it shows. They enter after price moves. They move stops emotionally. They exit out of fear or hope. That's not trading. That's reacting. A written plan removes emotion and replaces it with discipline. Comment My Plan Template to get a fill-in trend plan template you can use before your next trade. Now, let's break down how each part works. Chapter 2. Defining your entry. The first step in your plan is a clear entry rule. Most beginners ask, when should I buy? But they never define why they would buy. You must specify conditions for entry. A simple example entry rule could be, enter when price pulls back to support in an uptrend and shows confirmation. This is not vague. This is intentional. You're waiting for price to do something, not guessing. Comment entry logic if you want a short list of proven entry scenarios you can adopt for your plan. Once your entry is defined, the next step protects your capital. Chapter 3. Stop loss, your defense strategy. Now we must define your stop loss before you enter. This is the price at which your trade idea is invalidated. Here's the rule most professionals use. Place your stop just beyond logical structure, below support for buys, above resistance for sells. Never guess a stop. Never put it inside the level you're trading. The stop is your first line of defense. It protects your account from a single bad trade wiping you out. Comment stop placement rules, and I'll give you a simple grid you can use to place your stops every time. Once your entry and stop are defined, now we plan where we take profit. Chapter 4. Target, where you take profit. Targets are not about hope, they're about structure. You must define where you expect price to reach before you place the trade. 2 simple approaches. First target, nearest logical zone, next resistance or support. Second target, extended swing or higher time frame level. If you don't have a target before you enter, you'll exit too early. You'll exit too late. You'll second guess yourself. When you know where you'll exit, your emotions have no place to interfere. Comment target rules, and I'll share clear examples of logical target placements that align with your trade plan. Now, let's link entry, stop, and target into your risk control. Chapter 5. Risk management. Risk before reward. Before any trade is executed, you must calculate how much money you are risking. You do this like this. Risk per trade equals entry minus stop times position size. Here's the professional standard. Never risk more than 1 to 2% of your total capital on a single trade. That means if you have 500 euros, 2% risk equals 10 euros per trade. This keeps losing streaks from hurting your account and keeps you in the game while you learn. Comment Risk Calculator tool, and I'll send a simple risk calculator you can use before every trade. Now you have entry, stop, target, and risk. Let's wrap this into a simple process you can follow every time. Chapter 6. putting your trade plan together. Here's your step-by-step trade plan you'll use before every single trade. 1. Verify trend and structure. 2. Define entry conditions. 3. Place your stop-loss beyond structure. 4. Set your targets. 5. Calculate maximum risk. 6. Only execute if all conditions are met. This systematic plan eliminates guesswork, emotional reactions, impulsive trading. Instead, you trade with intent and discipline. Comment "Plan Checklist," and I'll give you a checklist audio cue you can listen to before placing trades. Now, let's eliminate the last mistake I see beginners make. Chapter 7. Execution mistakes to avoid. Knowing your plan is one thing, executing it is another. Here are the common execution mistakes that kill beginner accounts. Exiting early, moving stops after the trade starts, entering before confirmation, chasing trades after loss, leaving plans unwritten. If you follow the plan you wrote, none of these mistakes have room to happen. Trade the plan. Don't let the plan trade you. Comment "Execution Mindset," and I'll give my guided mindset checklist that keeps emotions in check while executing your trade plan. So let's recap your first simple trade plan. Define entry, define stop loss, define target, calculate risk, execute only when conditions are met. This plan transforms random decisions into consistent action. If this lesson helped you trade with clarity, do these 3 things. Hit like, subscribe for more basics breakdowns, and tap the bell. Down below, right now, tell me in the comments, which part of your trade plan do you struggle with most? I read every comment and tailor my next training to your needs. This is Online Trading Hub, helping you trade smarter, not harder.